and you demand that sort of thing from your leaders, right? But it's it won't end well.
That's one thing I always tell people. When they see something free, I said nothing's free.
Exactly.
If it's free, then you're being scammed.
Yeah.
You're gonna pay. There's the cost. Nothing's free, my friend. Mm-hmm. Okay, so let's switch over to your book now a little bit, and then we're going to circle back, okay, to the equities. Yep. Let's talk about your recent book, which again, thank you for a copy, Capital Offense. What inspired you to write Capital Offense, and the title, Why Some Benefit at Your Expense?
Now, so as I mentioned earlier, being an investor, I started seeing how central banks were manipulating interest rates in order to artificially drive asset prices higher, in the belief that somehow the benefits of that would trickle down to everybody else over time. And I didn't believe they would, and they haven't. And it's very harmful to the economy. And you could see that this would be a dead-end path. And so I started writing about this and talking about this with my clients for many years, and people were saying you should write a book about it because the way you talk about it is easier to understand. And I'm worried. I'm concerned about the next generation. If we don't change things, this is going to be the first time in modern history that the next generation is not better off than the one that preceded it. And to me, this is a moral issue.
Yes,
and this is a terrible legacy that we will leave to our kids. And so that's why I wrote the book.
Excellent. Well, I started reading it, and again, thank you. You said that the goal of the book was to help people understand how the economy really works. Why do you feel that was important?
So I felt that was important because a lot of people really don't understand how an economy works. Not because they're stupid. I believe the average person is very smart. But they've been fed these false economic doctrines, if you will, by policymakers, by academics who put forth economic laws as they would like them to be, not as they are. Convince people that you can get something for nothing. Convince people that as the government, we can overspend. We can just keep borrowing and you're all going to benefit and there won't be any consequences. It's not true. And a classic example of this was back in 1983 in France. The president, François Mitterrand, he reduced the retirement age from 65 to 60. So everybody could retire 5 years earlier. Now, when you're turning 60, that sounds great. I mean, who wouldn't want to retire 5 years earlier? I would like to. Mm-hmm. And they convince people that it's costless. Like nobody has to pay the consequences of this. Well, initially that's true, but the consequences are 15, 20 years in the future, where now there's not enough money for all the retirees because they retired 5 years earlier than they should have, and now the next generation has to foot the bill, right? So we all want to believe you can get something for nothing, but you can't. And so I'm here sort of like the splash of cold water in the face, as my wife likes to say, that like these are just the economic laws. Don't try change them because you don't like them. Just acknowledge what they are, how we can have the strongest economy, and then on top of that, we can impose our own ideology, how much we would like to distribute the wealth that we are all producing. But don't kid yourself with respect to what results in the greatest creation of wealth in the first place.
But one thing you had mentioned earlier about the Fed has a put. Now, my understanding of a put, and this is from the options, okay, that's where you hedge companies and businesses and investors use to hedge their investments. When you say put, could you explain to the audience what a put is?
Yeah, so a put option would be the ability to sell a stock at a certain price in the future. Let's say they buy a put option. Let's say Apple shares are trading at $100. So this put option would allow, you have to buy it, of course. This would allow your listener to sell Apple stock anytime over the next 12 months, say, for $90. Now, if Apple stock falls from $100 to $50 in the market, it's 50.
He's in the money.
But your client or your listener would be able to sell it for 90. So they could go into the market, buy it for $50, and now they have this put option which allows them to sell it for $90 to whoever sold them that put option. So they would make $40 on. So the put option means that if Apple stock falls, that your clients will not be harmed, or your listeners would not be harmed by that, and they would actually benefit from it. So that's what a put option basically is.
And your exposure is only the amount of the premium.
Exactly. Yeah, exactly. So you have the option to sell the stock at a certain price, and the opposite is the call option, where you have the option to buy a stock at a set price.
Yeah, the one thing I do want my listeners to know too is that when you're looking at a trade and then say you're holding Apple, okay, and you bought it on share, let's keep it at 100.
Mm-hmm.
Okay. And then next week Apple's up $10, so you purchased it at 100, now it's worth $110. All right, you made $10.
Yeah.
But what people fail to realize is somebody else on the other side of that trade that lost $10.
Mm-hmm.
You know, I mean,
Yeah.
it's here somewhere, leverage somewhere, but there's a winner and a loser on every trade.
Mm-hmm.
That's my takeaway, even though that's not my area of expertise.
Yeah, well, it was an opportunity cost, if you will, that the person who sold it at 100, if they could have made $10 more if they held on a little bit longer, but you know.
That's true. One thing I did learn, and I think this is something that is like a primary rule, you know, don't invest or speculate or enter the market, especially equity trading, when you can't afford to lose money.
No,
you only
absolutely.
invest what you can afford to lose.
Well, definitely only speculate with what you can afford to lose. I think investing, as long as you're investing in high-quality businesses, you're able to identify high-quality businesses or identify somebody who can identify them for you. And as long as you have an investment horizon that is long enough, then investing in high-quality companies over time, you should be okay. But you know, where people get into trouble is where they try to make a lot of money in a short period of time. And that's where, you know, if you're trying to do that, you should not be risking money that you cannot afford to lose, because you might get lucky, but eventually you're going to lose.
Absolutely. Absolutely. It's knowing when to get out, or knowing when
Yeah.
to, you know, take your earnings and move on, your profits. But what do you think is the biggest economic issues facing people today?
Well, for average American, I think it's just the cost of living. You know, and I think the inflation numbers are understated. Prices are rising higher than the government will tell you that they are. It's particularly difficult in terms of shelter. Now that's improving because there's a massive number of multifamily units that are coming onto the market in America. I think it was a record last year, and it's a very high number this year. So that should put pressure downwards on monthly rents for people. So that's good. You still have in a lot of northern states and western states, house prices are still very expensive for people. And to me, this is the main issue. There are others, but that's the main issue. Now, people have a choice about participating in the stock market if you want to invest in the stock. You can choose not to. But people don't have a choice in terms of needing a place to live. We all have to live somewhere. And in my opinion, the worst thing that the U.S. Central Bank did was distort house prices higher to create their wealth effect that we talked about earlier. So people, you remember the housing bubble in 05, 06. People were extracting literally hundreds of billions of dollars in equity from their homes and spending it, which is exactly what the U.S. Federal Reserve hoped that they would do, and so they like to see this. And so they drove house prices higher by keeping interest rates low in a growing economy. Now, a house has no business going up in price because it is not a productive asset. Remember earlier I mentioned that my motto is, be free and do no harm. I only want to benefit to the extent that somebody else is benefiting from my actions. In a free market capitalist system, whatever wealth you have, whatever material wealth you have, is supposed to be a reflection of material wealth that you have created and somebody else out there has. So your wealth matches the wealth that you created that somebody else out there now has. So it's a mutual benefit system, not a benefit at the expense of somebody else system. But that's what we're moving towards. So when our house here, we live in a suburb of Toronto up here in Canada. Our house we bought in 2001, so 25 years ago. It's worth 4 times what we paid for it back then. But our house is not producing 4 times as much stuff. It hasn't quadrupled in size. It hasn't moved to a new location that's 4 times nicer than the current one. It's the same economic good that a younger couple or immigrants to our country have to pay 4 times what we paid for it. So we benefit at their expense. When you look down on it from a societal perspective, when we make 4 times on our home, there was not a creation of 4 times the amount of capital. There was a redistribution of 4 times the amount of capital from the younger couple's bank account into our bank account. So it's a redistribution of wealth within the system from those who don't own assets or didn't to those who do or did.
But what about a multiplier effect? Whatever you purchase a home for, it has a ripple cascading effect on the economy, which is positive. You ever heard that?
Well, yeah, there's big controversy with respect to I think it's the Keynesian multiplier effect.
Right.
And and usually it's around government spending. And they'll say, well, if the government spends X, then that will result in a multiplier effect and that much more money will be spent in the economy. I don't believe it. I think longer term is very harmful. For an economy to grow, well, part of the issue is that people think that because, let's say I buy one of your bikes for $1,000, I've just provided you with $1,000 of income. Now, you can use that $1,000 of income and go buy, a scooter. And you provide or you buy a stove. So now you provided the appliance maker with $1,000 of income and sort of cascades through the economy and multiplies. Well, if that's really true, then we just have to spend a bit and it will keep rippling its way through the economy. And none of us will ever have to work anymore because we'll all be providing each other with incomes. But it's not spending and consumption that is the fount of economic prosperity. The fount of economic prosperity is what it was, whatever it was, that gave me the wherewithal to be able to first buy the bike from you. What enabled me to buy that bike from you was the fact that I created capital myself. I created a suit.
Mm-hmm.
Then I was able to get money. Now I can go spend. So if your income is dependent on me not creating capital, but getting capital from somewhere else, either by borrowing it or by maybe I've got a little money printer in my basement, I can print $1,000,
Mm-hmm.
then that is not sustainable. It's very harmful for the economy longer term. If your income is based on me being able to borrow more and more money to fund my consumption, then that multiplier stops. And if it's a result of me continuously increasing capital, making more and more suits, I can buy more and more bikes, that's sustainable. That's the difference.
Another thing I was wondering, looking back at your years in investment management, what do you think the public most often gets wrong about investing?
When people see soaring stock markets, what people get wrong is that, like I said earlier, more often than not these days, it's not a result of good things going on in the economy. It used to be. Now it can often be a result of bad things happening in the economy. So bad news is good news. Bad news in the economy means that the central bank will come to the rescue and lower interest rates and print trillions of dollars to buy assets. So from the broader perspective, that's the main thing that I think people get wrong. From an individual stock perspective, again, I think a mistake people make is that they don't differentiate the business from the stock. So we talked about Apple already, so we'll stick with that company. So Apple is an amazing business. I mean, they invest tens of billions of dollars every year in R&D, innovation, to come up with new stuff, and very few people can match that kind of spending on R&D. So they're doing lots of great things. But a great business doesn't necessarily mean that the Apple stock is a good stock to hold, because it depends on how expensive it is or how cheap it is. So you could have a great business, but I wouldn't want to hold the Apple stock if I thought it was too expensive. Conversely, you could have a lousy business, but if the stock was very cheap, you might want to hold it because it's only worth half of what the actual business is, and eventually you could make a lot of money on the stock. So just those two things, I think, differentiating between the business and the stock.
We talked about Alan Greenspan. Now, what have you been hearing on the street about the war and the rise of the stock market? It seems that the war is having no effect on the market. And what about the credit markets? What do you think? I'm a young guy, 25 years old, married, got a good job. What would you tell them about investing? They're both working.
Yeah.
Let's say throw in one kid and they're women.
Yeah, so take a long-term view. Don't try to become an overnight millionaire. Be well diversified within your investing in things that you understand. You know, there are way too many, free lunch promises. If it's like the old line, if something sounds too good to be true, it probably is. So, if somebody is saying, well, we can offer you a guaranteed, and I've heard this recently, a guaranteed 15% per year return. Well, the first question I would ask myself is, how come everybody else is too stupid to have recognized this opportunity?
Yes.
Right? If that opportunity is there and it was real, then investors would quickly buy it. It would bid the price up of whatever it is you're buying it. It would reduce the potential return. So don't believe in these too good to be true stories. Invest in companies that you have good understanding of. So Apple, you don't have to know how to make an iPhone, but you can understand that Apple makes great iPhones. You can understand that they continue to invest in their business and have great employees, and they have a strong balance sheet and all this kind of stuff. And so I like the business. Now let me look at the share price. Do I think it's very expensive or cheap? And that can get a little bit trickier.
Right.
Yeah, so there are different ways of looking at it, but the simple way is looking at the PE, or the price earnings multiple. So simply the price over the earnings per share. You divide one by the other, and so if the price of Apple is $100, if its earnings per share are $10, then the price earnings is 10. So $100 divided by 10. Now, the price earnings is a lot higher than that. Now, a higher PE, or higher price to earnings ratio, doesn't necessarily mean that the stock is more expensive, because it depends how quickly it's growing. So you could have a company that's trading at 20 times earnings, and it could be cheaper than a company trading at 10 times earnings if the 20 times earnings company is growing its earnings that much faster than a 10 times earnings company. Or you can find somebody who's got a good track record, and you can understand what it is they're saying in terms of how they invest and what to expect in different market environments. And not just equities. I mean, just personally, I've got some gold in my portfolio, and that's more of a hedge against central banks rapidly increasing the money supply like we talked about earlier. I've got some real estate. But again, real estate can be overpriced as well, so you've got to be careful there. But if you do find real estate that you think is attractively priced, and you have a long-term view, then I think that can be a good part of your diversified portfolio.
All right. Well, Paul, what are some of your personal interests? You play golf? I play golf.
I play golf, not well, but I play it and I love it. I like to cycle. I go on by bike about 2 or 3 times a week. It's just great exercise. I get to think. I like to bird watch. I like reading history. I like trains. I just love trains for some reason.
I have my first train.
No, I got lots of train books. I love train history. But yeah, those are things I like to do. I read a lot of economics, a lot of economic history and philosophy and stuff like that. I just find it so fascinating, and books going back a couple of hundred years. And it's really amazing that people from a couple of hundred years ago, when they're speaking economic truth, it's like they're speaking directly to you, and it's like a completely different era. Long before cars were even invented, or flying was something that they probably thought never would happen, stuff like that. Yet they're speaking to you, and very smart people and intellectually honest. I find a lot of the people from the past were more really just trying to get to the root of the issue rather than justify some sort of ideology. I mean, it's not that it didn't happen back then, but I think it's much less than it is today. So, yeah, those are things I like to do.